Imagine retiring at 55, traveling the world and living comfortably without financial stress. It's possible, but only if you plan smartly today. Retirement planning and long-term investing aren't just for the wealthy. They're tools that anyone can use to secure freedom, stability, and peace of mind for the decades ahead. 1. Why retirement planning matters. Retirement might feel distant, but the earlier you start, the easier it becomes. Life is unpredictable. Medical costs rise, inflation erodes savings, and Social Security may not cover everything. Without a plan, your golden years can become stressful instead of enjoyable. Consider Sarah, a 28-year-old graphic designer. She ignored retirement planning, thinking it was too far away. By 40, she realized she hadn't saved enough. Compare her to Mike, who started at 25, investing just $200 a month. By 40, Mike had a solid nest egg and the peace of mind to focus on his career and passions. The key lesson: time is your most powerful ally. Starting early allows compound interest to work its magic, turning small, consistent contributions into a substantial retirement fund. 2. Understanding long-term investing. Long-term investing is the backbone of retirement planning. Unlike short-term trading, which tries to profit from market swings, long-term investing focuses on steady growth over years or decades. It leverages compound interest, diversification, and patience to build wealth gradually. For example, investing $100 monthly at a 7% average return can grow to over $200,000 in 30 years. The earlier you start, the more pronounced the effects of compounding. Even small contributions, when consistent, make a huge difference. Key vehicles for long-term investing include stocks, ownership in companies historically offering high growth over decades. Bonds, lower risk, stable income streams, balancing a portfolio. Mutual funds and ETFs, diversified investments to spread risk. Retirement accounts, 401s, Ks, IRAs, and Roth IRAs offer tax advantages that accelerate growth. Story: Emma invested $150 a month in an S&P 500 index fund at age 25. By 55, she had over $500,000, enough to supplement Social Security and live comfortably. Patience, consistency, and proper allocation are the keys to long-term success. 3. Setting retirement goals. Before investing, you need a clear retirement vision. Ask yourself, at what age do I want to retire? What lifestyle do I want? Will I travel, start a business, or live simply? Setting concrete goals determines how much to save and where to invest. If your plan requires $1 million in retirement funds, your strategy will differ from someone aiming for $500,000. Story: Jake dreamed of retiring at 50 to run a small farm. He calculated expenses, factored in inflation, and determined he needed $800,000 in savings. By targeting investments in growth stocks and contributing consistently to retirement accounts, he stayed on track for decades. Without goals, retirement planning is guesswork. With them, every contribution, investment, and financial decision aligns with a purpose, making your money work toward a future you actually want. 4. Tax advantage accounts. Taxes can eat away at your retirement savings if not managed properly. That's where tax advantage accounts come in. 1. 401(k). Employer-sponsored accounts often include matching contributions. Always try to contribute enough to get the full match. It's free money. 2. IRA, individual retirement account. Traditional IRAs offer tax-deductible contributions, while Roth IRAs allow tax-free withdrawals in retirement. 3. HSA, health savings account. If eligible, an HSA offers triple tax benefits. Contributions, growth, and withdrawals for medical expenses are all tax-free. Story: Laura contributed to her 401(k) consistently and received full employer matching. Over 20 years, the combination of her contributions, employer match, and market growth nearly doubled her savings compared to self-directed investing without tax advantages. Using tax-advantaged accounts maximizes your contributions and accelerates growth, giving you more money to retire comfortably. 5. Diversification and risk management. Diversification is essential for long-term investing. Spreading money across stocks, bonds, real estate, and other assets reduces risk while maximizing growth potential. Think of it like a safety net. If one investment underperforms, others can compensate. Younger investors can take more risk with stocks, while older investors gradually shift to safer assets like bonds to protect wealth. Story: Tim invested only in tech stocks in his 20s. A market correction wiped out a significant portion of his portfolio. Learning from the experience, he diversified into ETFs, bonds, and international markets. Over the long term, his portfolio stabilized and grew steadily. 6. The power of compound interest. Compound interest is the most powerful force in wealth building. It's earning interest on your interest, and over decades, it creates exponential growth. Story: Alex invested $100 monthly starting at 25. By 65, assuming a 7% annual return, he had over $350,000. His friend Ben waited until 35 to start, investing $200 monthly. Despite contributing more per month, Ben ended up with less because he lost 10 years of compounding. The takeaway: start early and stay consistent. Even small contributions make a huge difference over time. Automating contributions ensures that you invest regularly without relying on willpower. Compound interest rewards patience, discipline, and time. Your most valuable allies in retirement planning. 7. Planning for inflation and healthcare. Retirement isn't just about accumulating money. It's about maintaining purchasing power and covering healthcare costs. Inflation slowly erodes savings, and medical expenses often rise with age. Plan for inflation by investing in assets with growth potential, like stocks or real estate. Ensure your portfolio can outpace rising costs. Healthcare is another critical factor. Consider long-term care insurance, HSAs, or savings earmarked for medical expenses. Unexpected medical costs are one of the biggest threats to retirement security. Story: Monica underestimated healthcare expenses and had to dip into her investment fund early. By planning ahead and using tax-advantaged accounts, retirees can protect their nest egg and cover rising costs without compromising lifestyle. 8. Retirement lifestyle and flexibility. Retirement is about freedom, not just money. Design a lifestyle that fits your goals: travel, hobbies, family time, or even entrepreneurship. Flexibility is key. The world can change, markets fluctuate, and personal circumstances evolve. Story: Robert planned to retire at 60, but by investing early and living below his means, he retired at 55. Instead of settling, he started a small consulting business for fun, generating extra income while enjoying freedom. Your retirement plan should be a roadmap, not a rigid script. Adjust as life evolves, stay disciplined with contributions, and ensure your investments align with your long-term goals. Money should serve your life, not dictate it. Conclusion: retirement planning and long-term investing aren't luxuries. They're essential steps to ensure freedom, security, and peace of mind. Start early, set clear goals, use tax-advantaged accounts, diversify investments, and embrace the power of compound interest. Plan for inflation, healthcare, and lifestyle flexibility. Your financial future depends on the actions you take today. Small, consistent steps compound into life-changing results. If this video helped you understand retirement planning, hit like, subscribe, and share to empower others. The best time to start planning for your golden years is now.